All right, so good evening once again. Today we shall continue our discussion on cost of capital. So far, we've had about 2 classes. Today will be the 3rd class we are going to have on cost of capital. We started with the introduction to cost of capital, after which we also dissected the importance of cost of capital. Just for the purpose of those that are just joining, because I know few our students joined during the course of last week, and then between last week and now. It's my nature just to bring everybody at par so that no one is left behind. So we started with the introduction to cost of capital briefly within the next 5 minutes. And we said cost of capital is the compensation required by the providers of capital. Then we also discussed the importance of cost of capital. And we said majorly, the key importance of cost of capital include, number one, for the purpose of project evaluation. When you want to determine, when a company wants to ascertain the financial viability of a project, cost of capital will be needed to discount the future cash flows to the present value equivalent using relevant investment appraisal technique. Then the second point is to use cost of capital to determine the debt equity proportion. So a company may want to know the percentage of equity and debt to be carried in the capital structure in order to minimize the overall cost of capital. The significance or usefulness or importance of cost of capital is not limited to those two. There are other usefulness of cost of capital. For example, cost of capital is used for performance evaluation. For those of you that are doing performance management, Mr. Shiwaju will take you divisional performance evaluation. So there are different methods of evaluating managers. One of them is residual income. We also use a return on capital employed, all right? However, for the purpose of this class, the main responsibility of any management of a company is to create value. And I mentioned to you when we started this topic that a company will be able to create value if the company is able to generate sufficient return over and above its cost, right? So what we are saying here is that if a company generates return on capital employed that is higher than the cost of capital, it means that the company has been able to create value. Provided you are able to earn €1 profits, it means that you have created value. So if your return on capital employed is greater than cost of capital, then it means the company has been able to create value for the shareholders. In that case, you can measure, you are using the cost of capital to benchmark whether the company has been able to create value. Another importance or significance of cost of capital is for valuation, all right? We use cost of capital for valuation. When you want to determine the worth of a business or of a company, right, you are expected to use, depending on the method that you want to use, but the most sophisticated method is the discounted cash flow method. So discounted cash flow method relies heavily on the use of a free cash flow, right? So cost of capital is what that will be used to discount the cash flows, to discount the free cash flow when you are valuing a business. All right. Of course, as we proceed, you are going to be seeing most of all those things particularly under the business valuation. So these are some of the significance of cost of capital. We then move on to discuss categories of cost of capital. And we said that cost of capital can be grouped into 3. One is traditional weighted average cost of capital. Then 2, project-specific cost of capital. Then 3, weighted average cost of capital of the combined activities. We started with the first one, which is a traditional weighted average cost of capital. We said traditional weighted average cost of capital should be used when information about ordinary share capital, preference share capital, or debt capital are given in a question. So when you are given capital structural information, okay, including dividend and interest, then you should know that you are supposed to calculate a WACC using the traditional method. Then we said that to calculate WACC, there are basically 4 steps you are supposed to carry out. The first step is to calculate cost of equity. The second step, you calculate cost of preference share. Step 3, you calculate cost of debt. Then step 4, you calculate weighted average cost of capital. We started with how to calculate cost of equity. And we said cost of equity is the minimum required rate of return expected by the ordinary shareholders from the firm. All right. Don't mind me that I'm kind of fast. It's because I just want to do a recap. All right. I will go back to to reset button as soon as I'm done with my recap. Okay. So we now said there are 3 methods of calculating cost of equity. The first one is using dividend valuation model. The second method is capital Z pricing model. And the third method is Miller and Modigliani. The Miller and Modigliani is not within your syllabus. All right. When you get to professional, you are going to use it under adjusted present value. Then capital as a pricing model is a topic on its own. So we are going to discuss it later on as we progress in the diet. Then, of course, we discussed dividend valuation model. And we said that dividend valuation model is used to calculate cost of equity when information about dividend and share price are given. All right. And it is calculated, cost of equity is calculated as the ratio of dividend to ex-dividend share price, depending on whether or not there's growth in dividend payments. Of course, there are formulas to do that. We also proceeded to discuss the concept of cum-div and ex-div share price. We said cum-div share price is the share price that includes dividend, and it is not used to calculate cost of equity. Ex-div share price is the share price that excludes dividend, and that is the main share price that should be used to calculate cost of equity. Therefore, if you are given cum-div share price, you must convert it to ex-div share price before calculating cost of equity. After which, we proceeded to discuss how to estimate growth rates. And we said that growth rate can be calculated using 2 different methods. We can use historical pattern of dividend payment, or you use Gordon growth model. We said that historical pattern of dividend payment should be used to calculate growth rates when past information about dividend payments are given in a question. When you are given the amount of dividend paid for the relevant years, then that means you are supposed to use the historical pattern of dividend payment. 2 different formulas. We discussed it during the time. Then, of course, we also said Gordon growth model should be used to calculate growth rates when information about earnings as well as the capital employed are given in a question. All right. So there are formulas you are supposed to know, which of course we discussed in the class. Then last week, we dissected the how to estimate cost of preference share. We said that cost of preference share is the compensation required by the providers of preference share capital. And the preference shareholders are entitled to fixed dividend in the business, and they must be paid before the ordinary shareholders. We discussed redeemable and also irredeemable preference share. We said that irredeemable preference share is the one in which the company is expected to pay annual fixed dividend, but the principal will not be repaid. And it is computed, the cost of irredeemable preference share is computed as the ratio of fixed dividend to ex-dividend share price. Okay? Then we proceeded to discuss cost of redeemable preference share. We said redeemable preference share is the one in which the company will pay annual fixed dividend and the principal at the maturity dates. Okay? We also mentioned that preference share can be redeemed at par, at premium or at a discount if the par value, we said that the par value of preference share is always quoted at 1 naira per share. It's always quoted at 1 naira per share. That's the nominal value. And then if it's at a premium, it means that it will be higher than 1 naira. If it's at a discount, it will be lower than 1 naira. And we said that to calculate cost of redeemable preference share, simply go ahead and calculate internal rate of return. So anytime you want to calculate cost of redeemable preference share, just go ahead and calculate internal rate of return. If you want to calculate internal rate of return, what are you supposed to do? Just 2 steps. Step 1, assume 2 discount rates that will produce a positive and negative NPV. Then step 2, calculate cost of redeemable preference share using the internal rate of return formula. It's as simple as that. All right. And I also mentioned that the only thing that differentiates redeemable preference share and then irredeemable preference share is if you are given the redemption dates. So if you are not given the redemption dates, you are going to calculate cost of irredeemable preference share. We then move on to discuss cost of debt. And we said that cost of debt is the compensation required by the providers of debt capital. And the debt holders are entitled to fixed interest. And that in the event of liquidation, the debt holders must be settled before the preference shareholders and also the ordinary shareholders. And we also said there are 2, we have redeemable as well as the irredeemable debts. And the irredeemable debts is the one in which the company is expected to pay annual fixed interest, but the principal will not be repaid. Then we also talk about, how to estimate cost of irredeemable debts. We said that the cost of irredeemable debts is calculated as the ratio of fixed interest to X interest price. All right, depending on whether or not there is tax. Okay. Then we move on to discuss cost of redeemable debts. We said that cost of redeemable debt is the one in which the company is expected to pay, all right, annual fixed interest and the principal at the maturity date. Just like you have for redeemable preference share, debt can also be redeemed at par, at premium, at a discount, and that the par value of debt is quoted at 100 naira per unit, except if examiner says otherwise. At times, examiner can ask you to use 1,000 naira per unit of the debt. All right. So, but where you are not told, at all time you have to assume that it is 100 naira. It is quoted at 100 naira per unit. And we also said that debt will only be redeemable if you are given the maturity date or the redemption date. If not, you are going to calculate cost of irredeemable debts. And we said to calculate cost of redeemable debts, you are supposed to calculate internal rate of return by assuming 2 discount rates that will produce 2 opposing NPV. And then step 2, you calculate cost of redeemable debt using internal rate of return formula. This is what we discussed in our last class. We also discussed the types of debts. We said that there are 2 types of debts at the high level. There are 2 types of debt. The first one is traded debts, and the second one is non-traded debts. And we said that the traded debts is a fixed income security, or they are financial security that can be that are tradable or that can be bought or sold in an organized financial market. Examples of traded debts include bonds, debenture, and then loan notes. Then we said that non-traded debts is the one in which non-traded debts are the securities that cannot be bought or sold in an organized financial market. That is, they are not tradable. And we said examples include bank loan as well as overdrafts. Then finally, we discussed cost of convertible securities. We said securities that can be converted by future dates. Examples: yes, bonds, debenture, or loan notes. These are examples of convertible security. My recording. Yeah. So like I was trying to explain what we did last time on cost of convertible securities before the network took me off, right? So we said that convertible securities are fixed income securities that can be converted to a known number of ordinary shares at a specified future date. And we said examples of convertible include preference shares, bonds, debenture, or loan notes. And that investor will only exercise their rights only if it is profitable, meaning that only when the conversion value is higher than the redemption value, that is when the the investors are going to exercise their rights. Okay, then we talk about how to estimate cost of convertible securities. We said that cost of convertible security is computed as internal rate of return, the same way you normally calculate cost of redeemable preference share or redeemable debt. The only thing that will change is the cash flow. Just go ahead and calculate internal rate of return. Okay, so we also talked about how to estimate market value of convertible securities, and that's the market value of convertible securities represent the present value of future cash flows. What are the future cash flows? The fixed dividend or interest, and then the conversion value discounted at the yield or rate of return on the convertible. So anytime you want to calculate market value of convertible, just go ahead and calculate present value of interest or dividend, and then present value of the conversion value. That's all you need to do. Add it up. That will give you the current market value of the convertible. It's very straightforward. All right. So, and that's where we stopped in our last class. So right now we are going to have a short examples just to demonstrate how to estimate cost of convertible securities. Then thereafter, we move to discussing weighted average cost of capital, which is the fourth procedure in traditional work. Okay, so let's have example to that effect. Okay, let me see. Yeah, let's have example just to demonstrate how to estimate cost of convertible. All right, so let's start with this example number 2. Let me see if you guys are still with me. Let me ask one of you to read for us. Yes, who will help us to read? Who is the CNN or NTA among us?
Let me read.
Nancy.
Let me read, sir.
Okay, Nancy, you wanted to read last week. Yeah, read now.
Singapore Limited has 10% convertible debentures with a current market value of 106 naira. An interest payment was made recently. The debenture will be converted to equity shares in 4 years' time at the rate of 40 shares of debenture. The shares are expected to have a market value of 3 naira 50 kobo each as at that time. What is the cost of capital to the company for the convertible debentures when company tax rate is 40%, and assume that the tax payment occurs in the same year that the interest payment arises? Thank you.
Yeah, thank you very much, Nancy. So that is the question. Look at, examiner is asking you, what is the cost to the company for the convertible debentures? You want to calculate the cost of convertible debentures. How do you estimate cost of convertible debenture? Very simple. Just go ahead and calculate internal rate of return. It's as simple as that. Therefore, what are you supposed to do? The first thing you need to do, you assume two discount rates that will produce a positive and a negative NPV. Then step 2, you calculate cost of convertible debenture using the internal rate of return formula. It's not more than that. No matter how big is the question, it's not more than that. The only area you can have challenge is your ability to be able to bring out the right cash flow that you need, which is fixed dividend or interest, then the conversion value. Remember, when you want to determine cost of convertible or market value of convertible, at all time, you have to select the higher of the redemption value or conversion value. Any of the two that is higher is what you are expected to use. All right. So if that is the case, let's move on to solve this question. The name of this company, the name of the company is Singapore. Singapore Limited. That's the name of the company.
Sir, can you scroll up, please? I cannot see you. Can you scroll up?
Okay. Can you see it now?
Yes, sir.
So you then say calculating cost of convertible debenture. Okay, KD, represented as KD. Let me see how many, so that are consistent with the font number. Oh, it's too much. 12 is okay. All right. So remember, we said that the first step you are going to do is to assume two discount rate that will produce a positive and negative NPV. Therefore, anytime you want to calculate internal rate of return, you are the one that will assume the discount rates to be used. You are the one that will assume it. That's one of the limitations of internal rate of return. Okay. All right. So let's start with 10%. Size 12 is okay. All right, so we then use this 10% to calculate NPV. So let me draw our table. 1, 2, 3, 4. Okay. Then another table. The main one, this is not complete. 5. All right. Then I also need 1, 2, 3, 4, 5, 6. Okay. And 4. That should be okay. Then join them together. All right. Oh, no, I don't want that. Let me redo it. All right, let me just cost of time. So the first column will be year, followed by description of items. All right. Then we have discount factor. Let me see. All right. Discount factor. Then, of course, we have present value. We also have another present value. Let me add one more column. We are going to have two different discount factor. Okay, let's do it this way. So Remember, we are calculating NPV, so you have to start from year 0. So the first item will be the current market value. You then go to the question, how much is the market price of this convertible debenture? According to the question, the examiner told us that Singapore Limited has 10% convertible debenture. This 10% is the interest rate that the company will pay to the debenture holders with a current market value of 106 naira. So the market price of the debenture is 106. So you then come here in year 0, put it in brackets 106. Close your brackets. Before that, we're assuming 10% first. Come here 10%. Sorry, there remain one column I need to put. One column for cash flow. All right. So this one, go to the next page, next column. So here will be 106. Then discount factor at 10% for year 1 is usually 1. Sorry, for year 0 is 1. Anytime you want to calculate discount factor for year 0, is always 1. Okay. So the next thing we need to do, of course, is to then multiply the discount factor with the current market value of 1 naira. So 1 multiplied by 106 will give us 106. All right. So we've I don't know what's happening tonight.
Okay, we
This
can hear
network
you.
the network is frustrating. Hopefully, I'll be able to cover tonight. Okay. Yes. Remember what I told you. We are calculating NPV. The first item, remember there are 2 cash flows to the security. The first one is fixed interest that the company will pay to the debenture holders. Then the second cash flow will then be either redemption value or conversion value. So we then go back to the question to go and pick relevant cash flows. We are told that interest payment was made recently. So we are able to use this 106 naira current market value because interest has been paid. So if interest has not been paid, it means that this 106 is cum int price. So we need to convert it to ex int price. But because it has been paid, no adjustment is needed. So we're also told that the debenture, now before that, we are given convertible, we are given interest rate of 10%. So 10% of 100 naira will give us 10 naira. However, you need to go further to the question and check if you are given company tax rates. Once you are given company tax rates, then you cannot use the interest rate that is given to you. You have to adjust for post-tax or after-tax interest. So in this case, we need to go and do our working for post-tax. You then come here, workings. When you are doing calculation, when you are writing an exam, you don't make workings. Your working should come as on your last page. You don't make it. You don't mix working with your main solution. That's the right thing to do. So you go to the last page of your answer booklet for the question that you are solving. The last page of the question you are solving, then go and start your working there. All right. So you don't mix working with the main solution. So the first working we want to do is to estimate post-tax interest. You can call it post-tax or after-tax interest. Remember what I told you. Debt is a cheaper source of financing because of tax, deductibility, benefits. Anytime you are calculating debt instruments, you have to adjust for tax. And that's what we are doing here. All right. So this is calculated as interest multiplied by 1 minus tax rates. 1 minus company tax rates, which is equal to, you then go back to the question, how much is interest rates? We are given 10%. So forget about the percentage because debt is always quoted at 100 naira per unit. By the time you multiply 10% of 100 naira, you are going to get 10. If it is 7%, 7% of 100 naira, you are going to get 7 naira. So just ignore the percentage. Use the figure as given to you. All right. So in the question, we are told that company tax rate is 40%. So 1 minus 40%, here will be 1 minus 0.40. Therefore, after tax interest is equal to 6 naira. You put 6 there. So I will then come here, fixed interest. How much is the fixed interest? We have adjusted for that, which is 6 naira. Just put 6 there. That's it. Then you also need to check. At the end of the day, in the final year, this interest, we go back to the question, what's the exercise date? When is the investor going to exercise their rights? We are told that the debenture will be converted to equity shares in 4 years' time.
In 4
So
years'
4 years'
time.
time, 4 years' time is the exercise date. All right. Therefore, it means that the company is going to pay annual fixed interest from year 1 up to year 4. So I would then say year 1 to 4. Because this interest of 6 naira is constant from year 1 up to year 4. Therefore, you need to go and calculate annuity factor. All right. Instead of you to be doing it one by one. So the annuity factor will be better. It will be faster if you use annuity factor. All right. So how do you then calculate annuity factor? So let's do working number 2 now. Annuity factor, AF. All right. So you only calculate annuity factor if you have a constant cash inflow. When you are given constant cash inflow, when you are given the same cash inflow for all the years, so instead of you to be listing it one by one, to be doing it one by one, you go and calculate annuity factor, or what we also call a cumulative discount factor. So how do you then calculate annuity factor? It is computed as 1 minus, open a bracket. Let me do it this way. Let me use a formula.
40.640.
Who is making noise? You want us to quarrel, right? Your mic is on. So okay, let me start with parentheses. Before parentheses, let me use this one. This, then parentheses. Okay. Oh, no, that's not it. You get out. You're the one causing confusion. Maybe you just want to use let me see. But this one had double. No, it doesn't have double. Okay, let me use this. Then all of this. So of course, let me just use this. I will then say, oh, sorry. Yeah. It's the one at the top that needs brackets. So this will be equal to 1 plus r, then raised to power, let me see if it will allow me. No. Okay. Let me see. Raised to power, let me just put it. I need that power. I'm not using the right distance. That's why. I will get it now. Let me check again. I need that power. Okay, let me use this. This is the one I'm supposed to use. 1 plus r, close the brackets, then raised to power minus n, raised to power minus n. So remove this one. I can then turn this one. Yeah, that's what I should have done before. It's fine now. Okay. So 1 plus r raised to power minus n divided by r. I will perfect it later on. So for now, let me just, so that I can complete my work. Then AF, annuity factor, is equal to 1. In the question, according to the question, R is equal to 10%. Okay, R is equal to, because we assume 10% discount rates. We assume 10% discount rate. Therefore, our R is equal to 10%. So I will then come here. 1 plus 1.10. That is 1 plus 10% will give us 1.10. So the exercise date is in 4 years' time. Therefore, minus 4. So here will be 0.1. Then, of course, here will be 1 minus that. Remove this one. Okay, so that's that. Then you use your calculator to get the final answer. So this will give us 3.170. So instead of us to be doing it one by one, for example, if you want to determine discount factor, for example, discount factor is calculated as, let me copy this. Discount factor is calculated as 1 plus r raised to power minus n. 1 plus r raised to power minus n. This is formula for calculating discount factor. So instead of us to be doing it one by one, okay, we then come here, for example, at 10% for year 1, discount factor for year 1 is equal to 1.10 raised to power minus 1. All right. I'm just trying to be, I'm just trying to give you an example because I know you are still a baby until you mature. By the time you have solved as many questions as possible, you would have understand the system. But for now, let me treat you like a baby, a newcomer, you know. So this would be 0.909. If you use your calculator, 1.1 raised to power minus 1 will give you 0.909. If you want to do for year 2, discount factor of year 2 will then be equal to 1.1, the same 1.1 raised to power minus 2. All right, this will be 1.1 raised to power minus 2. So this will give you, if you use your calculator, this will give you 0.826. So you continue to do it like that. For example, year 3. So discount factor for year 3, all right, this will give you 0.751. Year 4, discount factor of year 4 is equal to 0.683. So by the time you add up all the discount factor, you are going to get this 3.17. So instead of you to be doing it one by one, why don't you just use annuity factor? So that's the reason why you are using cumulative discount factor or annuity factor. All right, I believe you learned something from there. Okay, so the next thing we want to do, now that we have calculated our annuity factor to be 3.170, the next thing we need to do is to then get the present value, right? We get the present value.
All right, I
To
have a
get the
question.
present value at this 10%, you multiply the cash flow with the discount with annuity factor. Therefore, bring out your calculator from there. 6 multiplied by 3.17. All right, so this will give us approximately 19 naira. So here is 19. So the present value of fixed interest is 19 naira. Pay attention to this. You can see your cash flows are in two folds. The first one is the fixed interest. The second cash flow is either redemption value or conversion value. So at this point, because we are calculating cost of convertible debenture, and I told you that investor will only convert if it is profitable. So if the conversion value is higher than the redemption value, that is only when they are going to convert. If redemption value is higher than the conversion value, the investor will only wait until the maturity date to redeem the principal. They will not convert because it is not profitable. So at this point, we need to go and compare conversion value with the redemption value. So we can come here to say working number 2. Let me say this is working number 2. All right. Working number 2. Then number 3. We want to calculate the area of 1, the area of...
Sir, come again.
Pardon? Who is speaking?
It's me. How did you get that conversion value?
I've told you if you want to speak to me, just raise your hand. Don't distort my class. Anytime you want to ask me questions, just raise and I will allow you to talk. All right? We have not done conversion value. That's what I want to do now. Okay? So, when you are calculating cost of convertible, you have to compare conversion value with the redemption value. So we then go back to the question to go and check if the investor wants to redeem this debenture, at what price. So according to the question, we are not told how the debenture will be redeemed, whether it's going to be at par, as premium, or at a discount. We are not told any one of those. Therefore, you are going to assume it will be redeemed at par. So I will then come here. Okay, I will come here, redemption value equal to 100 naira. Remember, debt is always quoted at 100 naira per unit. So you put 100 naira there. Next, You compare this with the conversion value. Conversion value. How much is conversion value? I don't know it. I need to work it out. I will then go to the question, because you want to convert debentures to ordinary shares. How many shares you want to convert and what is the price? So to get the conversion value, you multiply the number of ordinary shares that you want to convert to, multiply it by the share price. So according to the question, we are told that the debenture will be converted to equity shares in 4 years' time at the rate of 40 shares of debenture. All right, so 40 shares of debenture. Then what is the market price? The share price are expected to have, the shares are expected to have a market value of 3 naira 50 kobo as at that time. Okay, in the next 4 years, when the debenture holders is going to exercise their rights, so the market price will be 3 naira 50 kobo. Therefore, 40 shares multiplied by 3 naira 50 kobo. What do you have there? So come here. So conversion value will then be equal to 40 shares multiplied by 3 naira 50 kobo. So this should give you 140 naira. Okay. That's 140 naira. So you then compare the higher of the two. So is it profitable? Of course, it is profitable because 140 naira is higher than 100 naira. Somebody will ask me, where did I get 100 naira? Of course, I told you already, the par value of debt is always quoted at 100 naira per unit. So if you are not told how the debenture or how the debt is going to be redeemed, you are going to assume it will be redeemed at par. At par means at 100 naira. If it's at a premium, it will be more than 100 naira. If it's at a discount, it will be less than 100 naira. So where examiner is silent, you are not told how it will be redeemed, you will assume that it will be redeemed at par, which is 100 naira. So you then compare this 100 naira redemption value with the conversion value. And I also said to get the conversion value, you multiply number of shares, number of ordinary shares with the market price at the exercise date. So that's what gave us this 140 naira. So because conversion value is higher than redemption value, it means that it is profitable and investor can exercise their right to convert to ordinary shares. So I will then come here, conversion value. Because conversion value is higher than redemption value. Here is 140 naira. So this is for year 4. Then I need to calculate discount factor for year 4 using, you already have it here. This is the number using the same formula that I've given you here. All right. So that's 0.683. I will expect that at your end, you use your calculator to check it the way I'm calculating it so that you follow through. This is 0.683. Then to get the present value, 140 naira, bring out your calculator, 140 naira multiplied by 0.683.
95.62.
Thank you, 95.62. Rounding, that's 96. So to get your NPV, when you are calculating NPV, NPV is the difference between the present value of cash inflow and present value of cash outflow. You are supposed to, first of all, you add up the positive numbers. All right, you then deduct the negative numbers. What do I mean by that? In our own case, right? In our own case, 19 plus 19 plus 96, that will give us 105, right? 115. 115 naira minus 106 naira, that will give a positive 9. Okay, our NPV is 9. We assume 10%. We got a positive NPV of 9. So in order to get a negative NPV, you need to assume a higher discount rate. So I will then come here 15%. Remember what I told you. When you are calculating internal rate of return, you are expected to assume 2 discount rates that will produce a positive and negative NPV. So we have assumed 10%. and that 10% produced a positive NPV of 9. And that is why we also increased to 15% in order to get a negative NPV. All right. So I will then come here 15%. 15%. So this will remain 106 in year 0. It will not change. Current market value will remain the same. So we need to go and calculate annuity factor at 15% for year 1 to 4. Can one of you do the calculation at your end? What is the answer? Annuity factor of year 1 to 4 at 15%. Are you there with me? Let me just copy. This one is at 10%. At 10%. Okay, let me just copy this. Copy this one.
2.855.
2.855. Thank you. So here is 2.855. That's it. You are correct. So we then multiply to get the present value. So that would be 2.855 multiplied by 6. That will give us 17 naira rounding. Okay. So we also calculate annuity factor of year 4 at 15%. That is 1.15 raised to power minus 4. What do you have?
0.572.
572, sorry.
0.572. So 0.572 multiplied by 114 naira. What do you have?
80 naira rounding.
80 naira rounding.
80. So to now get the NPV, you are going to add 17 plus 80. That's 97. 97 minus 106. That will give us minus 9. All right.
9.
So now that we have two opposite NPV, we have a positive NPV, we also have a negative NPV. We can then proceed to calculate internal rate of return, which is cost of convertible debenture. I will then come here, KD, that is internal rate of return, is calculated as lower discount rates. I think I've written the formula before. Let me just copy, so it will save time. Yes, this is it. Okay. So A is the lower discount rates, B is the higher discount rates. So I will just come here, put the number there, the NPV that we have calculated. We assume 10 and 15%. 10% is lower, just put 10. The NPV of that 10% is 9 naira, so put 9 there. The NPV of the lower discount rates is 9 naira. NPV of the higher discount rate is also minus 9. Just put 9. That's why you are seeing plus there. Okay. Therefore, B, which is the higher discount rate of 15, then A, lower discount rate of 10. Finally, you get your answer. KD, cost of convertible debenture, is equal to 9 divided by 18. That will give us 0.5. 0.5 multiplied by difference between 15 and 10. All right. So that will give us 2.5. 2.5 plus 10. That will give us 12.5%.
12.5.
Yes, 12.5%. That's it. Then If you like, you can round your number. Yes, Joshua, what's your question? Talk to me. You can round your number to say this is.
My question is, when we are using the 10, the way how you get the 10, that's what because the percentage on the convertible debenture is 10%. I believe it's 10% on the 106.
It's not that one. It is not the 10% on the 106. That 10% on the 106 is the interest rate, is the coupon rate. Pay attention. This is what I said earlier. When you are calculating internal rate of return, right? Joshua, you are supposed to assume, yes, you are supposed to assume two discount rates that will produce two opposing NPV. That is, one discount rate will give you a positive
No, that's not my
NPV.
question. When you are calculating the fixed interest, before we
Yes.
get when we apply the tax, we'll use the interest, then 1 minus tax. For that interest, we 10.
Pardon?
For the interest, when you're when you're calculating the fixed interest.
Yes.
You use 10 into bracket 1 minus 40%. That 10 is what I'm asking.
This is the 10. The 10 is the coupon rate. This is the interest rates.
Okay.
I mentioned this. So this 10% is the coupon rate, is the interest rate on the debenture.
Okay.
Yeah. So it's different from this 10%. Yeah, it's different from this 10% we assume here. All right.
What's in the question?
Okay. All right then. So Gloria, what's your question? Talk to me. After you, then Emeka.
Good evening, sir. I said,
good evening.
can you explain that conversion value line again? My network tripped, so I don't know how you got the cash flow of 140.
I said, in my explanation here earlier, I mentioned that when you are calculating cost of convertible securities, you have to compare, right? You have to compare the area of redemption value and the conversion value, because investor will never exercise their rights if it is not profitable, and it will be profitable only if the conversion value is higher than the redemption value. So anytime you are calculating cost of convertible security or market value of convertible securities, you have to compare the area of redemption value and also the area of redemption value or conversion value. And that's why we select this 140. The redemption value is not given in the question because you are not told how the debenture will be redeemed. And then in that case, you are going to assume it will be redeemed at par. Okay, you have to assume it will be redeemed at par, 100 naira. You then calculate the conversion value. And I say conversion value is calculated as the number of shares, the number of ordinary shares you want to convert to, multiplied by the market price at the exercise date. So you are given 40 shares. The market price at the exercise date in 4 years' time is 3 naira 50 kobo. Therefore, 40 multiplied by 3.5 will give you 140. So 140 is higher than 100 naira. And that's why we use 140. If, for example, the conversion value is 90 naira, 90 naira will be lower than 100 naira redemption value. Therefore, we are going to select redemption value. So we are in this particular question, we are selecting conversion value of 140 naira because that 140 is higher than the redemption value of 100 naira. Is it clear, Gloria?
Yes, sir. Thank you.
You are welcome. Yes, Emeka, talk to me. Emeka.
Good evening, sir.
Yeah, talk to me.
I have a problem with that calculation of in that fixed interest column, the calculation using 15%. I was able to get the 10, but the 15%, that 2.855, I've been struggling to get that.
Are you with your calculator? Are you with your calculator?
Yes, sir.
So bring out your calculator. Let me write it down for you here. Let me just copy this. So we are using 15%. This one is for 10%. All right, at 10%. So here we are using 15%. Okay, at 15%. Now, our R is 15%, which is 1.15. So from your end, Emeka, hope you are listening. So bring out your calculator. You are going to start from the parentheses, start from the brackets. So you are going to type 1.15 raised to power minus 4. Okay? Then you then say minus 1. Press equal to. You then say divided by 0.15. So whatever you have in your what do you have in your calculator, Emeka?
So
What did you get? Talk to me, Emeka. What did you get from your calculator?
you
Based on what I
said
just
divided
said.
by 0.25.
This is what you are going to. I'm repeating it for the last time. You are going to start from the parentheses, which is 1.15. So 1.15 raised to power minus 4. You press equal to. You leave it in your calculator, or you press equal to. You then say minus. Don't do divided by 0.15. Just say minus 1. Minus 1. Then divided by 0.15 equal. So you are supposed to get 2.855.
Okay, sir.
Have you gotten it?
Thank you.
Have
Yes,
you
sir.
gotten it, Emeka? Okay, then. So that's
Yes,
that.
I've gotten it. Thank you.
You are welcome. Somebody raised down the other time. Okay. Emeka, you can put down your hand now. All right. So that's that. So you can then comment on your results. You can then say the cost of convertible debenture cost of convertible the cost of convertible debenture is approximately 13%. That's it. This is how to calculate cost of convertible security. This is how to calculate cost of convertible security. So let's have one more example to demonstrate how to calculate the value of convertible. Okay. All right. Who is going to help us to read this? Who will help us to read it? No, not this one. Example number 1. Yes.
Let me read.
Okay, go ahead.
Lacazette PLC has in issue a convertible debenture with a coupon rate of 12%. Each 100 naira unit may be converted to 20 ordinary shares at any time until the expiry date, and any remaining debenture will be redeemed at 100 naira. The debenture has 5 years to run. Investor will normally require a rate of return of 8% per annum on the 5 years debt securities. Should the investor convert if the current share price is A, 4 naira, B, 5 naira, C, 6 naira?
Thank you very much. That is the question. That is the question, Festus. So examiner is asking, you have to be very careful. in this particular question, the requirement is for you to advise the price at which investors should convert. Examiner did not ask you to calculate cost of convertible. You only asked to advise the price at which they should convert. Therefore, what are you supposed to do? Remember, I told you earlier that investor will only convert to ordinary shares if it is profitable. If it is not profitable, investor will just allow the security to mature and then they will redeem it. So for you to know whether it is profitable or not, that means you need to compare the conversion value with the redemption value. However, for this particular question, what are you supposed to do? Very simple. The first thing you need to do is to calculate current market value if the debenture is going to be redeemed. What is the current market value if the debenture is going to be redeemed? Then you compare that with the conversion value at 4 naira, 5 naira, and then at 6 naira. So at any price at which the conversion value is higher than the current market value under redemption, then it is that price that you are going to convert. So, like I said, solution. The name of this company is Lacassette PLC. So the first thing you are going to do is to calculate the current market value if for the redeemable debenture. So you say calculating current market value of redeemable debentures. All right. So remember what I told you. Anytime you want to calculate market value of redeemable debts is calculated as the present value of future cash flows discounted at the yield or rate of return on the debts. So we have debenture here. We have redeemable debenture. What is the market value? To get the market value, you are going to calculate the present value of the fixed interest. Then you also calculate present value of the redemption value. That will give you the current market value. All right. So let me just copy the table I have before for the NPV we calculated earlier. All right. So okay. So I need only one. Let me delete this one. Okay. So we want to calculate the current market value of this redeemable debenture. So here will be market value, or we call it present value. So here is redeemable. Redeemable. All right. Sorry, redemption value. Redemption value. Okay. So according to the question, we are told that the debenture has 5 years to run. So if the debenture holders wants to redeem this debenture, of course, we are told it will be at par, which is 100 naira in 5 years' time. Therefore, here will be 5. All right. So here is 100 naira. Then, of course, let me change all of this. They are not useful so that you don't get confused. We don't even need year zero. So anytime you want to determine market value, you don't include year zero. All right, because once you include year zero, that means you are calculating, oh, did I delete? I delete something else. We'll come back to that one later. Let me just calculate this. So if you include year 0, that means you are calculating net present value, which is not what you wanted to do. So that's it. What's wrong now? Why am I deleting the wrong thing? This is the one I copied now. Okay. Let me just, why am I not saying undo here? Okay, maybe because of my, all right. This is the one I wanted to delete the other time. Then you clean all of this. So we want to calculate market value of redeemable debenture, right? Therefore, you go to the question, what is the, how are you going to redeem? Let me even start from the beginning. All right. So the first cash, remember my definition. I said that the market value of redeemable debt is the present value of future cash flows. What are the future cash flows? Interest, fixed interest, and also redemption value, discounted at the yield or rate of return on the debt. So in this particular question, if you want to redeem this debenture for Lacassetti PLC, we are told it will be redeemed at 100 Naira per unit. All right. So what is the interest? The interest rate is the same thing as coupon rates, and interest rate is 12%. Okay. So if interest rate is 12%, I will go back to the question and check again if I'm given tax rates. In this question, we don't have company tax rates. Therefore, I will just come in and put 12 Naira. Okay. So this 12 Naira will be paid for the next 5 years. So you're going to calculate annuity factor of year 1 to 5. All right. Then which discount factor are you going to use? Remember, it will be discounted at the yield or rate of return on the debt. So according to the question, we are told that investor will normally require a rate of return of 8%. So the yield is 8%. So that's what you are going to use. You are not the one that is assuming the discount rate. Examiner has already given it to you. All right, so here is 8%. So I need somebody to calculate for me annuity factor of year 1 to 5 at 8% using the same formula we have before. So that would be 1.12. Right? Let me clear what I have before.
993.
Pardon?
3.993.
Have you calculated 3.993? Thank you. You are a wise student. Yes. 3.993, you are correct. So multiply for me. 12 multiplied by 3.993.
48 approximately.
48. Okay, thank you. Then in the next on the final year, this debenture will be redeemed. How? We are told at par, which is 100 Naira. Therefore, somebody should give me discount factor for year 5 at 8%. 1.08 raised to power minus 5. What do you have? 0. What?
0.680. I mean 681.
681. Thank you.
Yes.
So multiply by 100 will give us 68 Naira. 68 plus 48 Naira will give us 116 Naira. Therefore, the current market value, or you call it present value, all right, is equal to 116 Naira. This means that if the debenture holders wants to redeem this debenture, at what price? It will be 116 Naira. That's the market price of this debenture. The market price of the debenture is 116 Naira. So you then compare this 116 Naira with the conversion value. So you then go to number 2, calculate conversion value. You say calculating conversion value. How do you determine conversion value? I mentioned it to you earlier on. Just multiply the number of shares you want to compare, you want to convert to, we multiply with the current market price, with the market price at the exercise dates. So in this question, examiner told us that each 100 naira units may be converted to 20 ordinary shares at any time until the expiry date, and any remaining debenture will be redeemed at 100 naira. So you want to compare and you want to convert 20 ordinary shares. What is the market price? Examiner has told you at 4 naira, at 5 naira, and at 6 naira. So let's calculate the conversion value. Chibuzo, I'm coming for you. Just hold on for me, please. Let me copy and paste it there. All right. So here will be number of shares. That's the number of shares you want to convert to. Then the share price. Then the conversion value. Conversion value. Okay. So we are converting 20 ordinary shares. Where is naira? Naira. So here will be 20. 20. Then another 20. Then at what share price? Examiner told you at 4 naira, 5 naira, then 6 naira. So to then get the conversion value, you multiply 20 multiplied by 4, we give you 80 naira. 20 multiplied by 5, 100 naira. 20 multiplied by 6, 120 naira. So at this point, you then need to advise, you need to compare. Should investor convert at 4 naira, 5 naira, or at 6 naira? Before that, let me answer. Chibuzo, you raise hand. Talk to me, please. Chibuzo?
Yes, can you hear me?
Yes, go ahead.
Okay, my question is, you mentioned that we should not show our working close to where we are solving. Like this annuity now. Is it that you will show it at the back of our answer sheets?
It's
Or
not
it
at the
be part
back
of
of the answer. It's not at the back of the answer booklets. When you are solving a question, ideally, your working should come last. The main requirement should come first, because working is not the main thing the examiner asks you to do. For example, you have to calculate NPV. Your NPV should be the first thing. So any calculation that you have done, any workings that you have done to get your NPV should come after, just like an appendix. Okay? So, and that's what we did here. You can see that our working is after the main requirements. In this question, the examiner is asking you to calculate cost of capital. We calculated the cost of capital. All the workings that we did to get the cost of capital came after our main solution. That's what I'm trying to say. So you don't start with working before the main solution. That's the ideal thing to do. You have to start with the main solution before working should come last. Is it clear, Chibuzo?
Yes, sir. Thank you, sir.
All right, you are welcome. Now, in this particular question, the examiner is asking you, should investor convert if current share price is 4 naira, 5 naira, or 6 naira? So the next thing you need to do now is to then compare the market price at redemption. If the company wants to redeem this debenture, it will be at 116 naira. The conversion value at 4 naira is 80 naira. Conversion value at the share price of 5 naira is 100 naira. Conversion value at the share price of 6 naira is 120. So examiner is now asking you, should investor convert? So investor, and you know that investor will only convert if it is profitable. If it is not profitable, they will not convert. Therefore, at 4 naira and 5 naira, investor will not convert. Investor will only convert at the share price of at the share price of 6 naira, since the conversion value of 120 is higher than the current market price of 116 naira. So that's what you are going to do. Of course, you need to advise. You then come here, investor should not convert at the share price of 4 naira and 5 naira, since the conversion value of 80 naira and 100 naira are lower than the current market value of 116 naira. Okay. However, investor or the investor should convert to ordinary shares at the share price of 6 naira, since the conversion value of 120 naira is higher than the current market value of 116 naira. That's all. That's what the examiner is asking you to do in this particular question. And it's as simple as that. Of course, no matter how simple it's a question, if you don't know, you don't know. So the bottom line is that anytime you are determining the cost of convertible security or market value of convertible security, you have to compare the redemption value with the conversion value. Any of the two that is higher, that's what you are going to use. That is if you are calculating whether you are calculating cost of convertible or market value of convertible. All right. So that is basically that. Let me know if you have any question for me. At this point, we need to move to weighted average cost of capital. After our class, I have to return all the things I deleted in the other question, in our other solution. All those figures are deleted from here. Okay. Yes. Any questions so far? If not, then let's discuss weighted average cost of capital. Remember how we started a few weeks ago? We said that to calculate traditional weighted average cost of capital, there are 4 procedures that you are supposed to carry out. We have discussed how to calculate cost of equity. Number 2, how to calculate cost of preference share. Number 3, how to calculate cost of debt. Now we're at the 4th step, which is to calculate cost of capital, that is weighted average cost of capital. So let me put it down for you. Calculating weighted average cost of capital, WACC. Okay. First thing first, what do you understand by WACC? What is WACC? Simply put, WACC is cost of capital. So let's put it this way. Now, weighted average cost of capital represents the overall cost of capital for a firm, weighted according to the proportion of source of finance in a company's total pool of capital. Okay, let me just put it down for you because of time. This represents the overall cost of capital for a firm weighted according to the proportion of each source of finance in a company total pool of capital. All right. So that is the definition for weighted average cost of capital. Now, how do you estimate WACC? How do you estimate WACC? Let me just summarize my points, okay? Method of calculating WACC. Let me put it that way so that we can finish on time. Methods of calculating WACC. Basically, there are two methods of calculating WACC. Basically, there are two methods of calculating WACC, including one, market value. You can use market value to calculate WACC. Then two, book value. Okay, so let's bring it down. Examiner can ask you, why is market value preferred over the book value in the calculation of cost of capital? All right, so you must know what you are doing. All right, so what do you mean by market value? Let's start with market value. Okay, what do you mean by market value? This is the price. Let me give it to you. This is the price. I'm not sure it's in your notes. This is the price determined by the market forces of demand and supply. Market forces of demand and supply. And it is the most acceptable. It is the most acceptable price by investors. Market value reflects the current market condition. Market value reflects the current information or market condition. That's one of the reasons why investors prefer it. Is the price determined by the market participants, not the book value. All right. So how do you calculate market value? Then say the market value of individual source of finance, source of capital can be calculated as follows. Okay. Now, what we are saying is that anytime you want to compute your WACC, you are supposed to weight the cost of individual capital that you have calculated. You have calculated cost of equity, cost of preference share, cost of debt. So if you now want to calculate your WACC, all those cost of capital that you have calculated before, cost of equity, cost of preference share, cost of debt, you are supposed to weight it you find the weighting using either book value or market value. So at all time, you have to use the market value for your weighting, except if examiner says you should use book value. Where examiner is silent, at all time, it has to be market value that you are going to use to do the weighting. Let me even put it for you. Let me put it down. The market value should be used at all times when calculating WACC, except when calculating WACC, except otherwise stated. So if you are asked to use book value, of course you use book value. At all time, you have to use the market value. All right. So how do you then calculate the market value? So you then say calculating market value. So the market value that you are going to use to do the weighting, this is how you are going to calculate it. So the first one is equity. How do you calculate equity value? You want to calculate the market value of equity. Equity value is denoted as E. Get out. Okay. So how do you calculate equity value? How do you let me number it? Let's say this is number 1. Then the second one will then be value of preference share. Value of preference share denoted as P. And the third one is debt value. Value of debt denoted as D. So first thing first, how do you calculate equity value? Equity value is calculated as number of ordinary shares multiplied by X dividend share price. Okay, so this would be number of ordinary shares, number of shares multiplied by X dividend. All those principles that we have discussed so far from day 1 to date, it is under the weighted average cost of capital. You are going to put them into practice. Share price, dividend share price. So this is the formula for calculating equity value. If in the question you are not given, you are not given number of shares, then alternatively, you can say, all right, you can say equity value is equal to share capital. All right, let me see the other one where I use raised to power. Okay, let me just use this one. All right, so alternatively, you can see if you are not given number of shares, then it will be, let me close this too. Let me close the gap. X dividend. So it will be share capital multiplied by, share capital divided by share capital divided by nominal price. All right. So when you divide share capital by the nominal price, it will give you a number of shares in the company. Okay. All right. Then you then multiply with the X dividend share price. You multiply with X dividend share price. That's all. That's all you need to do. Get out, so I don't need you. Let me give you space. All right. Okay. So the same thing. If you now want to calculate the market value of preference share, it's the same formula that you use for equity that you're going to use for a preference share. The only difference is just that here you are referring to equity, but here you are referring to preference share. It's no more than that. Let me shorten it. It's not equity value. Okay. Or you can also say, if you are not given number of shares, it should be share capital divided by nominal price or nominal value of the preference share. Okay. Multiplied by X dividend share price. All the principle that you apply under cost of equity also apply to our cost of preference share. Principle in terms of X dividend share price. So if preference dividend has not been paid, you need to go and calculate. It means that the share price given to you is cum div share price. So you must convert it to X dividend share price for the preference share. Then the last one is the debt value. How do you calculate debt value? So debt value is calculated as nominal value of the debt, multiplied by X interest price divided by 100 naira. Okay, let me copy this. X interest price divided by 100 naira. Remember, debt is always quoted at 100 naira per unit unless you are told otherwise. It has to be 100 naira. Okay, so these are the ways in which you can calculate the market value of individual source of capital, all right, that you are going to use for the weighting of your work, all right, for the weighting of your work. So that's that. So the next thing we are going to discuss is the book value. All right, what is book value? How do you use book value to calculate work? Evelyn, what's your question? Talk to me.
Okay, sir. So the preference shares. You said it's number of shares.
Your line is you are inaudible. I'm struggling to hear you. Evelyn, can you come closer to the mic or to your speaker?
Sir,
Evelyn,
can you hear me now?
better.
Sir, can you hear me?
I can hear you better now. Talk to me.
You said the value of preference shares is number of shares multiplied by the X dividend share price. Is it the number of ordinary shares or the
no?
Shares?
As implies, this is preference share. Preference share is different, so you have to focus on preference share. It is
so
preference share.
Number of
preference share, yes.
All right, thank you, sir.
You're welcome.
So the second formula for this preference share, I'm seeing equity value there. It's not supposed to be preference share value.
I will error of mine. It's error of mine. I will change it. Thank you for the observation. Value of preference share denoted as P. All right, so that's that. Now, what do you mean by book value? All right, this represents the figure This represents the figure of value as shown in the balance sheet. So the value given in the balance sheet is your book value. It is also known as the par value, face value, nominal value. Okay. It is also known as par value, nominal value, or face value. Face value, that's the balance sheet value. All right. So anytime you want to calculate WACC using the book value, you have to combine ordinary share capital with reserves to form the proportion of equity, which you are going to use to do the weighting for equity. Let me put it down for you. When you're calculating WACC using the book value, method, where are you? Using the book value method, ordinary share capital plus reserves must be added together to form the proportion of equity. In the company's total pool of capital. In the company's total pool of capital. That's what you need to do. All right. Let me, for example, let's say you have ordinary share capital of 1,500 naira. You have reserves of 500. You also have, let me do it this way. Let me go to the other side. For example, okay. So we also have preference share capital, say 400. We have debt capital, say 600. So by the time you add up everything together, the total pool of capital will be 3,000. All right, total will be equal to 3,000. Right. So let's also say that, you have cost of equity. You have been given cost of equity to be equal to 15%, right? You're also given cost of the preference share, KP, right? You are given cost of preference share to be equal to 12%. For example, this is KE, right? Let's also say you are given cost of debt, KD, to be equal to 10%. All right. So these are the cost of individual capital that you are given in the question. So if you now want to calculate, right? If you want to calculate WACC, what we're using the book value. So what we are saying is that you are supposed to add ordinary share capital plus reserve to form the weighting for equity, to form the proportion of equity. In this case, if I want to calculate my WACC, I will say KW equal to, using the book value, what is the proportion of equity? Equity will be equal to, let me pick one of these. So the weight of equity in the capital structure, right? Equity in this case will be equal to 1,500 plus 500 divided by the total capital, which is 3,000. Then multiply by cost of equity, which is 15%. Plus, I will do the same thing for preference share. For preference share, the weight of preference share will be 400. Preference share will be 400 divided by 3,000 multiplied by cost of preference share of 12% plus the weight of the debt, which is 600. Let me copy this. Which is 600 divided by the total of 3,000 multiplied by cost of debt of 10%. So at the end of the day, I will add everything together. This guy plus this guy plus this guy will give me the total, will give me the average cost of capital. That's why we are saying that weighted average cost of capital represents the overall cost of capital for a firm, weighted according to the proportion of each source of finance in a company's total pool of capital. So you are using book value to do the weighting of your cost of capital. You are using market value to do the weighting. If you want to use market value, all this, whatever the figure you have here is what you are going to use for your weighting. All right. So this is what you need to do when you want to calculate WACC. So at this point, the next thing we are going to now discuss is the formula to calculate WACC. I can then say WACC, okay, WACC. I'm coming for you, Nancy. WACC can be calculated using the formula below. Okay, how do you calculate WACC? All right, so this is the formula that you can use. KW equal to, let me pick this. All right, let me pick this. No, that one's too big. Let me use this. Okay, let me put this one into brackets. Hopefully this guy will allow me. I know, it will not allow me. Let me see. Let me try it again. It is not, okay, let me start from the beginning. Yeah, get out. I was looking for a shortcut before. Forgetting that no easy way. Okay. Nancy, I'm coming for you. Let me insert my formula first. All right. So let me start with parentheses. Should I start with parentheses? Using this, come back here. All right then. No. This is not right. Let me copy this. Put it here. Better. So for me to now calculate the formula that you can use to calculate your WACC will be equity value all over equity plus preference share, value of preference share plus value of debt multiplied by cost of equity multiplied by cost of equity. Okay. then plus let me remove slants, copy, multiply. Okay, so I will do the same thing for preference share. Value of preference share, P, multiplied by value of preference share divided by equity plus preference plus debt, multiplied by cost of preference share. Then, of course, plus value of debt, which is D, divided by equity plus debt, equity plus preference plus debt. Okay, then multiply by after-tax cost of debt. So that's all. That's what you are supposed to do. This one will be 1 minus T, 1 minus tax. All right. So that's that. This is the formula for calculating weighted average cost of capital, where E equal to equity value, P equal to value of preference share, okay, then D equal to debt value. Of course, KE equal to cost of equity, KP equal to cost of preference share. Then KD equal to cost of debt. T equal to company tax rates. All right, so that's that. If I don't want to use formula, I can also use a tabular method to get the same answer. All right, so this is the formula for calculating your work. Again, I repeat, remember, we started with cost of equity. So from this work, like I told you, this work is the ultimate, is the overall cost of capital for a firm, weighted according to the proportion. So we are using the proportion of equity, proportion of preference share, proportion of debt to do the weighting. All right. So as you can see from this formula, it means that you must first of all go and calculate the cost of individual capital. That is, you calculate cost of preference share, sorry, cost of equity, cost of preference share, then cost of debt, before you can then calculate weighted average cost of capital. So depending on the information you have in the capital structure, at times you may not have preference share. If there's no preference share, then the formula in the middle, you are going to remove it. It will be the two extremes. You calculate for equity, you calculate for debt, then you add the two together. That's all you are going to do anytime you want to calculate work. Yes, Nancy, you raised hand the other time. Talk to me. Are you still there, Nancy?
Yes, I'm still here, sir. I wanted to ask, although your formula has addressed my question, I wanted to ask, what if we are given company tax rates? How do we treat it? But your formula has addressed it already.
It's all right. No worries. So, let me see if we can have a short example to demonstrate this. Let me see. No, I'm not solving this one. Let me see if we can have a short example within the next few minutes, just to demonstrate the form. So after this, we are done with all the explanation of traditional work. The next thing we are going to be doing now is purely calculation. So in our next class, all we are going to be doing is to be testing past questions on this. So that's all we need to do. Let me look for a short example question that we can use to demonstrate how to calculate WACC using the book value as well as the market value. So we know that that is out of it. Okay. I'm not going to solve this one. In our next class, I'll bring a more technical question than this. Okay. Let me. All right, so let's solve this as an example number 4 for today. Example number 3. So who will help us to read this question quickly? Who is helping us?
The accounts of Ostra PLC reviews the following capital structure. 1 naira ordinary shares, 2 million naira.
Give that one. Market value.
Okay. Market value of the above shares is as follows. Ordinary shares 3 naira 75 kobo ex dividend. Debenture stock 18 naira. The cost of equity is estimated to be 20%. The cost of debt is 7.5% after tax. What is the weighted average cost of capital using 1 book value, 2 market value?
Thank you very much. So examiner wants you to calculate WACC using the book value and then the market value. So let's solve. I will then say solution. That's too big. I'm going to reduce the font. Okay. Solution. The name of the company is Ostra. Ostra, is it a limited or PLC? Ostra PLC. Okay, so we're asked to calculate in the question, the requirement is to calculate weighted average cost of capital. All right, so I would then say calculating weighted average cost of capital. Please, on the day of your exam, don't go and be writing WACC. You have to write it out in full, all right? You have to write it out in full before you then put it in brackets, WACC or KW. So let me just copy the formula I have here. Don't need to repeat it again. All right, so calculating WACC. So WACC is computed as equity value over equity plus preference plus the. In this question, as you can see from the capital structure, okay, as you can see from the capital structure, there is no preference share, all right? Since there is no preference share, you only have ordinary shares as well as a debenture. So the middle formula will not be there. So we ignore this one, we delete it. It's not part of the formula that we need. All right, so we then have this. So life is easy now. So this is the formula for calculating WACC, right? So I would then say, number 1, using book value. So examiner wants you to calculate WACC using the book value. So I would then come here. Let's repeat the same formula. All right. So in the question, remember, we said that when you are calculating WACC using the book value method, ordinary share capital and reserves must be added together to form the proportion of equity in the company's total pool of capital. When you look at the table given to you, this is the capital structure of Astra PLC. Capital Astra PLC finances its operation with ordinary share capital and also our debenture. Therefore, because we are using book value, you are supposed to add ordinary shares plus reserves. So in this case, the weight of equity is equal to 5 million naira. So I will then come here, equity is equal to, for the purpose of this class, let me break it down, equal to 2 million. Let's restrict our number to million. 2 million plus reserves of 3 million. Then divided by the total. The total capital is 6 million. Multiplied by cost of equity. So according to the question, we are given cost of equity of 20%. Cost of equity of 20%. So examiner has made life easy for us. So there's no need for you to go and be calculating cost of equity and be wasting time. All right. So examiner has made life easy for us. Then, of course, let me remove P from here since we don't have P. Again, we don't have P here. All right. So that's that. So then for the other side, which is the debt, the value of the debt is 1 million divided by total value of 6 million. Okay, 6 million. Multiplied by after-tax cost of debt, we are given 7.5%. The after-tax cost of debt is 7.5%. It's as simple as that. So I can then come here to say, 2 million plus 5 million, sorry, plus 3 million will give us 5 million naira. So here will be 5 million. All right. So what do we have here? So I will then come here. KW equal to 5 divided by 6. Bring out your calculator from your end. 5, let's do it together, please. 5 divided by 6 multiplied by 20 equal to 16.67. So the average of the cost of equity is 16.67% plus the average of the debt. That will be 1 divided by 6 multiplied by 7.5. That is 7.5 divided by 6.
1.25.
1.25%. Correct. So you then add up the two. Our work will then be equal to 16.67 plus 1.25. What do you have there?
10.92.
17.92%. So that means our work is approximately 18%. Work is approximately 18%. So this is how to calculate work using the book value method. Let me change this one to approximate. Okay, so that's that. Then the second method, we are to use the market value. Walter, what's your question? Market value.
My question is that what if we're given a tax raise or we're not given in this question?
If you are given a tax, of course, you have to adjust for tax, 1 minus tax. Don't worry, as we proceed, by next class, you'll be seeing all of that. All right. So if you are given tax rates, you just have to apply 1 minus tax. But because we don't, examiner has already told you that your cost of debt is already after tax. So you don't need to go and adjust for tax again. That will be double dipping. All right. Walter.
Yes, sir. Thank you, sir.
Okay. You're welcome. So using the market value, again, it's the same formula we are going to use. It's the same formula we are using, but however, you need to go and calculate the market value of equity, market value of debt before you can calculate your WACC. Let me just copy one of this. Let me copy this. So we need to go and determine the market value of equity. So I will then say workings. Working number one, I want to determine equity value. Equity value is calculated in the question. I need to go and check if I'm given number of shares. In the capital structure, I'm given share capital. Examiner did not give me number of shares. Therefore, the formula to use will then be, let me copy only this side. The formula to use will then be share capital divided by nominal price. Let me check what the examiner call. Is it nominal price or okay? We're not told. Just one error. All right. So divided by nominal price. The nominal price is the face. Is the par value. Is the face value. All right. Then multiply by X dividend share price. X dividend share price. Remember what I told you. Anytime you want to calculate WACC, you have to use the market value method, except examiner asks you to use the book value. All right. So it has to be market value always. So all the formulas that I've given you before, this formula for calculating market value is the one you are going to use. That's why we are using this, because we have checked from the question that we don't have number of ordinary shares. You are given share capital of 2 million naira ordinary shares. So that's why we are using that one. So I will then come here from my workings. All right. So let me copy this. Okay. So equity value, the share capital is 2 million naira. You don't include, pay attention, please. You don't include reserves when you are using the market value. You only consider reserves when you are using the book value. Okay. So this one is 1 naira. The nominal price is 1 naira. Then multiply by X dividend share price. The X dividend share price given to us is 3.75. Therefore, 3.75 multiplied by 2 million. What do you have?
7.5 million.
7 million.
500,000.
That's it. Then you calculate the market value of the debenture. The market value of the debt is the nominal value multiplied by X interest price. Multiplied by X interest price. X interest price divided by 100 naira. You can see examiner did not tell you whether the debenture is quoted at 100 naira per unit, so you are going to assume it's at 100 naira. Okay, so in this case, our G, the value of the debenture, the market value of the debenture will then be equal. I will go to the question. What is the market value of this debenture? The market value is 1 million naira. Okay, 1 million naira multiplied by the X interest price, according to the question, is 80 naira. Okay, then divided by 100. That's it. It's no more than this. This will give us 800,000. Then you then calculate the total value, total market value. Total market value will be value of equity, market value of equity plus market value of the debenture, which is equal to, we calculated market value of equity to be 7.5 million plus the market value of the debenture to be 800,000. So this will give us 8.3 million. 8,300,000. So this is what we are going to use to do the weighting. 7.5, we use that to do the weighting of equity. 800,000, we use it for the weighting of debenture. So I will then come here. This one is 7.5 million. So 7,500,000. Okay. Then divided by the total value, which is 8.3 million. All right. Then multiply by cost of equity of 20% plus the value of the debenture, which is 800,000. That's the market value of the debenture divided by the total value of 8.3 million naira. All right. Then multiply by after-tax cost of debt. So my WACC will then be equal to 7.5 million divided by 8.3 million multiplied by 20. What do you have?
18%.
No. Give me from the left. 7.5 divided by 8.3 multiplied by 20. Okay. 8.3 equal to, then multiply by 20. What do you have?
18%.
18.07.
18.07. 18.07. Is that what you told me before?
Yes, sir. That's right. Yeah.
Sorry. Then 800 divided by 8,300 multiplied by 7.5. 0. What?
0.7.
0.73.
7.2.
Okay, so add the two together. That will be 18 point what?
0.79.
18.79.
79%.
18.79%.
Approximately 19%.
Yeah, approximately 19%. So at all time, market value, WACC using market value will always be higher than the WACC using the book value, because the market value represents the current market information. It reflects the market information. All right, that's why WACC using market value will always be higher than the book value. Okay, so this is how to calculate weighted average cost of capital using the book value and also the market value method. All right. So like I said, in our next class, we are going to do more of a calculation. It should be purely calculation for the entire period until we get to project specific. So we are getting there to the end of a cost of capital. All right. So let me know if you have any question for me so that we can close the class. Then I will release you. Any question for me so far?
Yes, sir.
Is there anything?
You said
Yes,
when
who's speaking?
calculating, is Nancy, that when calculating market value, we don't use reserve. I want to know why.
You don't use reserve now. So when you are, it is only when you are calculating the book value that you consider reserves. It's just a rule or a principle or concept. So there's no major or critical reason for that. But the most important thing is that anytime you want to calculate your work, you have to use the book, you have to use the market value. And like I mentioned, the market value is the most acceptable price by the investors because it is determined by the market interaction of market participants. It's more realistic relative to what you have in your balance sheets, historical value. All right. So and when you are using the book value, you just have to add the reserves to ordinary share capital. There is no basic reason for, of course, you can't be adding reserve plus the market value, yeah.
Okay. So when calculating a cost of debt, what if we are not given the X interest price? How do we then determine that?
You have to calculate. Once you are given tax rates, you must adjust for tax. You have to adjust for tax. So like Vato asked me the same thing the other time. So by the time we begin calculation next week, by the grace of God, you will be seeing all those adjustments. In most cases, examiner will know you are the one that will determine the cost of individual capital by yourself. You are the one that will calculate cost of equity, cost of preferential, cost of debt. So examiner will not give it to you in most cases. All right. So you are going to see all of that next week. Okay. Yes. Any question? Let me see those of you that are still here with me. Some of you have disappeared. About 8 of you have disappeared. But I can see Evelyn is still here with me, keeping me company. Thank you. Shola is here with me. Anthony.
I'm here with you as well.
No worry. Anthony is here with me. Augusta, Biola, Chibuzo, Choma Ofobeze, Choma Udeze. Then I can see Emeka. I can see Ezine. Ezine, I've not heard your voice today. Talk to me, Ezine. Are you there or you are attending by proxy?
Good evening, sir. I'm there.
Good evening. How are you? Yeah.
Well, fine, thank you.
You're welcome. Farida, let me hear your voice. Farida. Okay. Yeah, Ahmed Akinwale, Anson, Joshua, Joyce. Joyce, how are you? Talk to me.
Good evening, sir. I'm very well, thank
How are
you.
you? Good. Good to hear your voice. Anson,
Yes,
Joshua,
sir.
Shonde. Yeah, I can see
Joshua,
Judith.
Joshua is here.
Pardon?
Joshua is still here.
Oh, okay, Joshua. Yes, Joshua Shonde. Is it Shonde or Shonde?
Shonde.
Shonde, okay.
Yeah.
Then I can see Jane. I've mentioned Joyce. Okay. Judith, Lovett. I can see Matthew. I can see Festus. Nancy is still here, keeping me company. Then Abiodun, Oduwale, Oluwafemi. Then Omotayo. Tayo, what's up? Then I can see Amarachi. I can see Lukman. Ruth is here with me. Sandra is here keeping me company. I can see Alimat. Then Shubomi is also here. Of course, Walter. I can see Akko. How are you, Victoria? Victoria Akko. Then Zaza. Wow, Zaza. Zoom user. Thank you, everyone, for waiting behind to the last moment. We are going to meet again by the grace of God next week, Monday, when we shall be doing purely calculation of the cost of capital. All the principle we have discussed so far for the last 3 periods. All right. So it is in our next class, we'll be putting them into practice. All right. We'll be doing the application of all those concepts that we have discussed. Thank you once again, everyone. Then good night. Bye-bye.
Thank
Thank
you,
you. Good
sir.
night.
Good
Bye.
night, sir. Good night.
Bye.
Bye-bye. Yeah.
Oh, sorry, I wanted to ask him, will this this work note be shared?
Certainly. It will be shared.
Oh, okay, thank you, sir.
You're welcome.
the video? When will the video be posted? When will the video be posted?
Maybe you are in the group, you know the procedures. It will be posted latest tomorrow. All right. It will be posted tomorrow. Yeah.